Hello and welcome to this pre-budget special show titled What Markets Want. And clearly, as the title suggests, what we are going to do over the next 30 odd minutes is to try and grill our two guests as to what is likely to be dished out in the budget and what is it that the markets want to hear from the finance minister. It's the first full budget, so to say, of the BJP government, and the expectations are riding sky high. With me in the studios, two distinguished gentlemen, Amay, Hattangadi, Swanand, Kelkar of Morgan Stanley Investment Management. Gentlemen, thanks so much for joining in.
Thank you.
Amay, I was reading the note that you guys put out with. There's a lot of luck, a little bit of work that has gone into play till now in the first 9 to 10 odd months, as the case may be, with the new government. What do you expect the budget to dish out on the fiscal front? Because that's the big talking point right now.
Well, like you rightly said, we've titled our report Putting Serendipity to Work, right? Clearly there's been serendipity. We've had a confluence of good luck, which is what we've seen. We've seen oil prices come off very significantly. And the real question is that we know the math, right? We know how much we are saving in dollar billion, how much we're saving as a percentage to GDP because of lower oil prices. The key question now is, how are you going to put that to use? How are you going to put the saving in oil prices to use, and where are you going to be spending the money? So the key questions, I'm sure, before the finance minister is not just how much you've saved, but the question is, where are you going to put it to work? Are you going to put it to work towards populist measures? Are you going to put it to work towards building roads and railways, new national highways? Where are you going to put this to work? And I think that is the crux of this budget come February 28th.
Swanand, the key point though is that he's got a bit of a leeway. I was hearing a market commentator, I think Rhythm, mentioned that he's probably the luckiest finance minister in the last 20, 25 odd years. Now my question is, yes, the key question is how to or where to put it to work, but how much of it to put it at work as well. A lot of talk around what the fisc deficit number could be. What are your internal assessments?
Sure. So just to extend what Amay said and put this thing in context, something that we have been worrying about, and in India worrying about has not been very fashionable, but we have worried about it for the past few months, is who is going to lead and who's going to fund the next capital expenditure cycle. If you look at the SOE banks, which are still 75% of the banking system, they don't seem to be in a position to lend to the next cycle because they're still grappling with the issues of the earlier cycle. All of them have asset quality issues. And guys who developed the assets in the last cycle, the asset developers, so to speak, are in a deleveraging mode. They are selling down assets. So how does this gridlock break? Because a new cycle, and if it has to be a sustainable one, has to start with capacity creation. That's what happened in the 2002-2003 cycle. So I think by exclusion, the only place which is left who can do the capital expenditure, it looks like the government. And couple that with the windfall. So we actually use the word serendipity, that you are grappling with a problem and something somewhere suddenly clicks, which gives you a leeway, which gives you an idea about how to solve these issues. The question which you ask in what could be the fiscal deficit number, like every finance minister for the past few years has been putting out a fiscal deficit number for the next year, which has been lower than this one, right? So there is obviously a hat tip at least to fiscal consolidation. We could get some number which is in the high threes as a percentage of GDP for FY16. We don't know what that actual number could be, but I think 4.1 for this year will be pretty much there. We can quarrel with the numbers and the mathematics of it, but I think there will be a path to consolidation. We'll expect the fiscal deficit number for next year to be lower than this one.
Will the markets like that, Amay? Is the market already pricing in a 4.1 because of all that's happened, fuel subsidies, a raising of excise duty, some rationalization in welfare schemes? Is the market already pricing in a 4.1, 3.6, 3? And will it be disappointed if the numbers are slightly awry?
I think the bond markets are clearly pricing in a fiscal deficit which is lower than 4.1, right? The question is it going to be 3.6 or some number between 3.6 and 4.1 is what we have to wait and see. But bond markets are clearly expecting the fiscal deficit to come down. The equity markets, in a sense, want the government to spend, right? Because that's good for equity markets. What we are not quite sure in the equity markets is, where is this spending going to, in what direction is this going to go? But if you ask me what the markets are expecting, yes, from the borrowing programs, expectation, etc., it's clearly going to be lower than the 4.1 of this year. It is going to be some number, hopefully between 3.6 and 4.1.
Yeah, but you heard, people like Arvind Panagaria, for example, saying that it might pay to be slightly loose in FY16
right,
and kickstart the capital cycle or the investment cycle.
Right.
Where do you think the government will veer towards? Will it stick to the fisc numbers and maybe bat for a ratings upgrade? Forget a status quo, an upgrade over the course of the next 6 to 12 months, or will it say that, hey, let me worry about it 1 year down the line for now. Let me go out and loosen the purse strings and kickstart the investment cycle. Where do you think it will veer towards?
Well, I think there's been a lot of discussion about loosening the purse strings and doing some pump priming, of the government being the only one to do the heavy lifting. Like Swanand clearly said, the private sector is not really in a position in terms of its balance sheet strength or the cycle in the economy to start to embark on a very significant capital spending. So yes, clearly the government realizes that they have to do much of the heavy lifting. The question really is that the history shows that when you try to step up spending, it typically first goes towards the populist areas, right? If you want to embark on some capital expenditure, those projects are typically longer gestation. So you don't end up spending within the next 3 months, 6 months, 12 months. Sometimes they take longer. They're spread over a few years. So for us, the quality of the spend is just as important rather than just saying that we are stepping up expenditure. Because the chances often are that they go towards the revenue expenditure. And we looked at the numbers this year as well, right? We started the budget of 2014 by saying that we're going to take capital spending up in the high teens, 17, 18%. What we are saying this year to date, from April to date, is that the capital spending is actually down 11%, right? So what happens often is that it's the revenue spending that keeps chugging along and growing, and the capital spend does not do what it's supposed to do. So while pump priming is nice to talk about, it's good to say we are stepping up expenditure. It's for us, what is most important, the granular detail, the composition of that expenditure, rather than just saying that we are taking fiscal deficit up from 4.1 to 4.5. The risk is that it goes into the wrong areas.
Yeah, that's a point. But just one small boo-boo, if at all, is that the 14th Finance Commission might increase the state share of central taxes as well.
Right.
Now, does that kind of limit the headroom for splurging for the government at large? So is that a big problem or no? Not really.
First, I think I would not call this word splurging, because this is a very necessary expenditure that you need to incur. We'll have to wait for the recommendations of the 14th Finance Commission when they're tabled in the Parliament and what goes through eventually.
But there's a certain expectation anyways.
There's a certain expectation that the share goes up. I think directionally it's a positive thing to do. And the Prime Minister has also talked about it, saying that he wants the Chief Ministers and the states to be partners in his development agenda. And giving states more leeway to implement schemes which they think are most appropriate for the states, I think is the right thing to do. From the budget standpoint itself, will they allocate more towards the states, and will the Finance Commission's recommendations be implemented in this budget itself? I don't know. We need to see. Get into the next budget, let's see. We don't know about it. But from a market standpoint, if we see that happening, that there's more being given to the states, and even if that means that the fiscal deficit number is not exactly 3.6 but 3 point something, I think we will take it positive.
On that note, let's take a very quick break. What we've discussed is the broad roadmap for the fisc numbers. We come back and talk about where is that the spending could be done and how is it that the equity markets will take it. Back from a break in just a bit. Back with a discussion on what markets want from the budget, in conversation with Amay Hattangadi and Swanand Kelkar. Okay, gentlemen, one note that I read spoke about this possibility, and it sounds logical, that if indeed there is spending that happens with multiplier effect on certain sectors, etc., there could be, contrary to what we all want, a bit of an inflationary pressure domestically because of multiple reasons. Now, is that desirable as well? The world is in a deflationary zone. A little bit of inflation coming out necessarily, will that be taken negatively, or you think that's fine?
So I think as we stand today, we are in an inflation sweet spot. If you look at it globally, there are countries who are flirting with deflation, have a problem of their own, and there are countries which have almost double-digit inflation, which have a problem of their own. So we are in a good spot as far as inflation goes, and the commodity, and our view has been fairly negative on commodities for the past few years, and it continues to be so. It's a basic demand supply kind of an argument. We think that the deflationary pressure that comes in from the commodity side will be enough to offset, if at all there is any inflationary pressure from the fiscal push towards capex in the near term. You might get up a few ticks up and down, but I think it is more imperative to get that gridlock broken rather than worry about the near term inflation. But what you raise an important point. If the same money gets channelized towards non-productive assets, it's more towards doles. I think the inflationary outcome will be there for everybody to see. And this is something which we have grappled in the past as well. We come through a double-digit CPI inflation phase for a fairly long time. So in the near term, a capital expenditure related inflation, I would call it a good inflation. I would say it's a good thing to have in the near term because it is eventually creating capacity and will structurally get inflation down.
So then, which brings me to my question, where do you think money will be spent? Now, the common belief, I've read 5 notes, and the common belief is that it will be on sectors which have a multiplier effect. Now, where do you think money gets put in first? Where will the larger outlays be? Swanand?
So I think the larger outlays, I mean, I don't know where they will be, but they should be.
Should be.
Yeah, they should be in places which can be started with a very short time frame. They shouldn't be in stuff which will take 2 or 3 years to get off the ground. It shouldn't be in long, very, very long gestation projects which will take really long time to fructify. The obvious infrastructure areas come to mind. I mean, the roads, bridges, railways, things like that, which are, to borrow somebody else's phrase, are shovel ready. You can just start working on them fairly quickly because land acquisition is not as big an issue for some of the others. So the Make in India and outlays towards that might take slightly longer to come and fructify because you need land acquisition, you need more clearances. But some stuff such as infrastructure, which is clearly in deficit, which we clearly need to step up on, a push either from the windfall that we have or even from borrowing outside the budget through multilateral institutions or government agencies. That would be, I think, the ideal place to put that money to work.
Is the market bullish on this space then, Amay? Because I also read some rating agencies report which speak that the worst for the construction industry is over. There's a lot of talk of spend. If the spend does come about in the infra space, do pockets within this in the listed space become attractive?
Well, I think we've said this before in one of our previous notes as well. Clearly, money needs to be spent in infrastructure, and we think that money will flow in. The balance sheets of many of these companies need to be repaired, and as money flows in, as orders flow in, hopefully the balance sheets will start looking better. But the point we've always made before, and I would repeat that, is it's unlikely that the supernormal returns that the infrastructure sector enjoyed from 2003 to 2007 will be repeated, right? So the country needs more infrastructure, the infrastructure spend will continue, but can they make supernormal returns again like they did before is unlikely.
Okay, what else aside of infra? Where do you think that big spending push could or will come?
Well, I think it'll be in specific areas of infra rather than just make a broad brush. So I think we will see spending in railways, we will see spending in national highways. We should see spending in power distribution because we do have, we seem to have power generation capacity, but we need to sort out the coal linkage portion and the distribution part. So I think there will be spending on both sides, ensuring fuel linkage and ensuring distribution. So I think that these will be specific pockets, and there's been a lot of talk about spending in defense. And there again, we need to see whether how much of it will be imports and how much will be domestic production. So this could be some of the potential areas.
So there's a bit of a chalk and cheese here, right? Defense stocks have actually gone up substantially ever since this talk of defense spending came out. It hasn't happened with infrastructure. To an extent, it hasn't happened with real estate, so to say. It hasn't happened with core construction companies either. So what do you think the market will like? Assuming that there's enough spend on defense, enough spend on power, enough spend on railways, where do you think the market will start moving towards in the first 2 or 3 weeks post the budget?
I think we have a slight advantage this time around as equity investors because there is a very strong survivor bias, right? I mean, we have gone through such a long period of stagnation and nothing happening. Companies with weak business models, with weak balance sheets are already on the deathbeds. So there's a very small clutch of companies which has survived this prolonged downturn and has still kept their head above water. So I think we need to focus on those companies which have survived the downturn. Some of it will go there, as you said, defense has been hyped a lot of it is already into the stock prices, and which is a worry not only for the infrastructure sector in general, but for the market. We think that there are some sectors which have been really, really hyped and there is not much happening on the ground commensurate with the hype that surrounds those stocks. So I think stick with the survivors, stick with people who have proven business models and who have stood the test of time. And today you have the advantage of knowing who those guys are, because probably they have gone through the worst 2 or 3 years in terms of the India fixed capital formation cycle.
Yeah, but you would bet on what, Amay? I mean, by the nature of the work that you do, you probably bet a lot more on large caps. But my question is, would the market now start looking at the broader market opportunities within these pockets as well? Because there is only as much that people can buy into the large caps. At some point of time, they get saturated because of valuation or FI is not willing to buy and stuff like that. Does the broader market open up post the budget in infra, construction, railways, housing?
I think it will open up. We'll see new companies coming up. And like Swanand mentioned, we'll also see the companies which have survived this prolonged slowdown also start doing well. At the beginning of every cycle, it's extremely difficult to pinpoint and know exactly which ones will do well, right? So at this point, the guessing game is going on in the markets, and the markets are probably rewarding a broader basket. We might see a narrower basket of companies actually do well. It could be a completely new set of companies which have probably some niche technologies which are going to help. It could, there could be some companies, say in solar or wind power or defense, which we're not really heard of. And every new cycle, we see creation of new companies. And unfortunately, we are often very obsessed about the ones that did well in the last cycle and trying to see when they start reviving. But we could see a completely new set of companies. Maybe some of them are not yet listed, and we see new listings too. So it's difficult to pinpoint exactly at this stage of the cycle which those could be.
And another interesting way of doing the same thing is maybe to look at ancillaries around the space, even the financiers. When you buy equity into a financier who funds infrastructure projects, you are actually taking a portfolio approach and reducing the risk of an individual failure, right? When you take a bet onto an individual company, you run that much. It's a high risk, high reward game. But if you want to be more pragmatic about it, if you want to be more conservative about it, I think financiers is also a good option.
Okay, a bunch of names or a bunch of spaces to watch out for from Amay and Swanand. What we'll do is hit a break yet again. We come back, we've discussed about the obvious suspects. Now we'll talk about the outliers and their broad market view. I mean, a lot of people talk about how the markets are trading at slightly higher than desirable valuations. We'll try and figure out which way the markets could move post the budget. Back with what markets want in discussion with Amay Hattangadi and Swanand Kelkar. We've discussed what the fisc math could look like in the budget. We've discussed the obvious suspects in the budget. Now let's talk about maybe some outliers and their broad market perspective as well. Where do they think the market could move up or move over the next 12 to 24 months? I just use the term up because I believe everybody believes that the market is going to go up. Let's assume we are in a band of anywhere between 8,700 to 9,000 on Feb 27th or Feb 28th, as the case may be. Post-budget, what's the view for the short term, let's say a couple of months, and then of course the long-term view as you guys normally take for your funds?
So the post-budget reaction, as we said, will hinge on a few things, right? It will hinge on the composition of government expenditure.
But assuming it goes as planned.
If it goes as planned, I think the markets are going to take it positively. The markets are going to like it. I don't think the markets are very, very fixated on the 3.6 number. Some slippage here or there will be taken care, will be pardoned, I guess. What the markets may not like is out and out dole or social spending type of thing. So that part is very clear. In terms of the longer term direction, I think we need to take a step back and see what's happened over the past 12 odd months. What's happened is there has been a cyclical recovery in the economy. Be it the new series or the old series, I mean, the direction is, I think, thankfully the same. I think now going forward, it is going to be what we call the show me phase. Show me the delivery. We have already re-rated some of the stocks.
Sure.
We have already re-rated almost many of the sectors.
Right.
I think these will be times of differentiation. When high ownership, high expectations meet bad delivery, bad earnings, it's a very bad combination. I mean, it can be a combination of, it can be a recipe for disaster. So I think you have to be really careful now in terms of differentiating where the actual on the ground recovery is happening. And then I would say, I would make a bold statement saying that if you believe and if you convince yourself that you have caught those recovery sectors well, don't worry about near-term valuations. If you think that there is a 2 or 3 year recovery happening, and if you can pick those sectors, I mean, we have bets in the commercial vehicle space, which we think is on a longer term recovery cycle, at least for the next 12 to 18 months. We are not too bogged down by near-term valuations.
What else, Amay? Commercial. So we're talking about cyclical recovery in the economy. So outside the budget, never mind what the budget doles out, there are a few things that will anyways do well. Swanand mentioned about
so there are these early
what
cyclical
else?
turnaround plays which are natural beneficiaries coming out of a prolonged slowdown.
Yeah.
And the broader theme is the movement of goods across the country. And you're seeing this through commercial vehicles or trucks. You're seeing this in the port volumes. You're seeing this in the rail container traffic. So these are some of the themes where you're saying that as the economy started picking up, the movement of goods across the country has started improving. The trade has started improving at the margin. And you're seeing all these themes playing out within this broader theme. So you are seeing these beneficiaries, and this is regardless of, and this has started even before monetary easing in a significant way. This has started even before any government policy. So this is coming naturally from a deep economic trough.
And can it continue, Amay? Because these stocks aren't exactly what they used to be a year ago. They moved up quite a bit, albeit on a low base. Can it continue?
I think, like I said, this has happened despite government policies or lower interest rates.
Yeah.
If government policies and interest rates were also going to act as further tailwinds, then of course these themes could continue to play out much longer.
You were talking about we being in a sweet spot on the inflation front or globally on the deflation front. Do you believe the rate cycle is also to our liking in the next 12 months?
It should be. I mean, we could debate on the magnitude, and I have no clue exactly on what that magnitude is going to be.
Yeah.
But the direction is clear. That we are on an easing path.
And therefore, would the leverage plays also be a tactical idea? I mean, I don't know whether you do it in portfolios or no, but tactically, are leverage plays a good idea to play the market?
My thinking on that is don't go and look out for specific aspects of leverage plays, etc. Because if you think about it this way, the cost of borrowing in the economy over the past 12 months has actually come down. Right, even without a rate cut. The rate cut happened only last month. So the cost of borrowing in the economy is actually down 100 basis points. So effectively, there has been a rate cut in the economy. And even after the 25 basis points rate cut, I don't see too many banks having passed it. So the rate cut is more symbolic. It's more, at least a 25 basis rate cut currently is very symbolic. I would still say back the good business models rather than just going out and looking for highly leveraged companies which will benefit on the day when the governor comes and cuts rate. But I don't think it's a sustainable investing model.
So the good business models are not cheap. That's my question. That's my point now. So we've talked about recovery plays. Other than the recovery plays, the good business models are terribly expensive in certain cases. Do those become more expensive, or do they stay expensive, or would now be the turn of beta and some of the beaten down sectors to come to the fore?
Right. Like you're clearly saying that there's been in some ways a quality bubble in the markets. Right. The quality stocks have continued to do well. There's been a divergence in the valuations. But there's also been a divergence in the earnings track record of the quality companies versus what was perceived as beta or value. So I think that divergence will continue. And like Swanand said, now there will be some distinction between some of these companies trading at elevated valuations. The ones that will continue to deliver on earnings will continue to do well. So at a point of time when the broader universe of stocks in the country are growing at 8% or at best, some high single-digit number of earnings growth. The ones that continue to show the 20% or better earnings growth, I think they will continue to do well.
Which are those?
Well, I think that's what we have to wait and see, right?
But you're obviously betting on some of these themes actually doing well. Which are
right. So one, like I said, was the early cyclical turnaround plays where we think that theme will continue. There are more tailwinds to that story. The second is we think the aspirational consumer theme. I think that has started playing out. You could keep arguing whether it's urban growing faster, rural growing faster, but the aspirational consumer story is a durable story. Sorry, it's an enduring story. I didn't mean consumer durables, but consumer staples, durables. It could be consumer lending. It could be a broader basket of stocks which fall in that aspirational consumer theme, and that I think that's an enduring theme.
Okay, Swanand, lastly, PE investors typically do this, or VCs do this. Nascent businesses buy into them cheap and hope for them to ride. Anything in the listed universe that as a sector is looking nascent? I mean, you could argue e-commerce was one, but it's already been 12, 24 months since these guys have come into play. Anything else, or for that matter, e-commerce logistics, anything that you guys like at your funds?
I think that is the same space that we are talking about, which is something which benefits from the overall improvement in the movement of goods and services in the country.
Got it.
I think that's a big theme that we are playing. GST will play into it. E-commerce will play into it. Lower interest rates will play into it. Lower fuel prices will play into it because it's easier to transport things from one place to the other. So if you look at an international comparison, the amount of freight that goes around in India in the context of its GDP is abysmally low. And there are artificial barriers to it. So just open up your minds and think about what can move from one place to the other very efficiently and bet on people who are involved with that part of the business.
Gentlemen, thanks so much for being with us today on this very special pre-budget show called What Markets Want. It's been an interesting conversation with Morgan Stanley Investment Management on what they believe could be the fiscal situation on Feb 28th, and of course the pockets that you should be watching out for the budget and even otherwise. Hope you enjoyed watching the show as much as we enjoyed doing it. Thanks for being with us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.